Okay, Chapter 7, we deal with accounting for foreign currency transactions. So what happens with that is that when there's a global company that's either buying or selling overseas and using US dollars to buy products that then have to get converted into euros or pesos or wherever they're purchasing, there's going to be a difference in those then the conversion rates between when they initially make the transaction to when they pay for the transaction or get paid. So we have to factor those in. So the first one is just kind of showing you kind of how that works. But so if we have a company that sells products to a customer located in Switzerland, and they're selling the products on November 20th. The invoice specifies that the payment will be made on February 20th, so it's going to be like 3 months out, in Swiss francs, in the amount of 100,000 Swiss francs. So we have different exchange rates. So on November 20th, it takes $1.05 to buy 1 Swiss franc. So then they want us to prepare our journal entries. So on November 20th, when we really make this sale, we are going to set up accounts receivable, and then we're going to credit sales for this amount. So it's 100,000 Swiss francs times the exchange rate at that time, which is $1.05. So it's going to be $105,000. So if they had paid us right then, we would have received $105,000. They would have paid us 100,000 Swiss francs. It would have went into our bank. Our bank would have given us the exchange rate, which would have been $105,000. However, we didn't get the cash. It's in an accounts receivable. Well, then the auditors come along and they say, okay, now it's the end of the year and your financial statements need to be prepared, and they want all of these receivables or payables to be valued at truly their net realizable value. So then they go and say, okay, well, what's the exchange rate on December 31st? Well, on December 31st, it's $1. So if my exchange rate is $1, then my accounts receivable balance should only be $100,000, right? It shouldn't be $105,000 anymore, because if they send me $1 of Swiss francs and it goes to my bank's just going to give me $1. So my accounts receivable needs to go down by $5,000. So then this is just kind of my background information. So then the journal entry, we're going to have to credit the accounts receivable for $5,000, and then we have to debit something. So then the debit is a foreign currency exchange loss for $5,000. So kind of lengthy. I don't really, on the test, I don't care how you kind of abbreviate that, as long as you know it's a loss and it's relating to that foreign currency adjustment. So then they've lost $5,000 because they gave these people 90 days to pay. So had they paid them there, they'd gotten $105,000. Now we're down to only getting $100,000, but at least from the auditor standpoints, our accounts receivable are properly valued. Then on February 1st, February 20th, we get paid. Then on February 20th, though, it's 85 cents for 85 cents to get 1 Swiss franc. So then we've gone down even further. So now the exchange rate an abbreviation is actually that. So then now it's gone down even more. So then when they go to pay us, they're going to pay us 100,000 Swiss francs. So we're going to get cash at the 100,000 Swiss francs times 85 cents. So then we're going to get $85,000. we have an accounts receivable on the books at 100,000. So then we're going to credit our accounts receivable 100,000, because again we gotta remove it completely when they pay us. But then now we have a $15,000 difference, and our 15,000 difference is another loss. So then our foreign currency exchange loss will go up by another 15,000 because the U.S. dollar, it's actually strengthening. We're getting more Swiss franc for our money, but because they didn't pay us back there, we couldn't capitalize on that. So actually, when the U.S. dollar strengthens and we're getting paid and not the U.S. dollar, it results in more of a loss. Where it could go the other way. So if the U.S. dollar strengthens, and we have a receivable, that's going to result in a loss. If it was the other way, if it was a payable, then it would have been a gain. Then you could flip-flop that to say, okay, if our U.S. dollar weakens, if it takes more U.S. dollar to get the Swiss franc, then the receivable would result in a gain, and then the payable would result in a loss, because then we'd have to come up with more U.S. dollars to buy those foreign currencies. So this is like a good one to know kind of for your multiple choice questions, and then maybe to help you as you're building these journal entries know, do I have a gain or do I have a loss? Okay, so that's going to be one section. Then we get into, okay, because if you're looking at these and you're thinking, okay, why this company didn't do anything. They sold some product in November. The only thing they're guilty of is giving their vendor or their customer 90 days to pay. So they end up having a $20,000 loss that they really couldn't have controlled, because it all has to go back to the U.S. dollar, which the company has nothing to do with. So then what they end up doing is they end up entering into these hedges. So if they know that they've got this money tied up, they're going to enter into, it's like a derivative instrument where they hedge that to say, okay, we're going to hedge this exchange rate at whatever the financial institutions will give them a contract for, so that they can kind of guarantee what's going to happen with that U.S. dollar. Then they know that they're not going to be at that much of risk. So then let me see, I'm going to erase this, and then we'll do another one where they hedge it. So then if we have, okay, the company sells $675,000 to inventory to a customer in France. The customer demands that the invoice be stated in euros, and the exchange rate on the date of the sale is $1.35. It takes $1.35 of US dollars to buy 1 euro. Accordingly, then the invoice is written for 500,000 euros. And the payment is due in 60 days. The company feels that the U.S. dollar has been oversold and is likely to rebound, and lowering the U.S. equivalent of the receivable. The current futures price for a 90-day delivery of $1.30 reflects this view. So then that's what that's saying, that futures price of the 90-day delivery at the $1.30, the $1.30 is what they can hedge it at. So they have it right now at the $1.35, but they can find a financial institution that will hedge them for that $1.30, and that's what they're going to go with. Okay, so then they give us some rates down below. So in May, that's when they contract to sell. The exchange rate is the $1.35 to equal 1 euro. So then what we do is we set up the accounts receivable for that. So we're going to debit our accounts receivable, and then we're going to credit our sales for the 500,000 euros times the $1.35. So that's the 675,000, and they gave us that in the problem also. Okay, so 675,000. And then we enter into the hedge. We enter into the hedge contract or the future contract. But we don't have to make a journal entry because at that point in time, all that's happened is we've just signed the contract. There's no difference in liabilities or receivables or anything. So we enter into a future contract at not the $1.35, but at the $1.30. So no entry is required. Okay, then on June 30th, we need to prepare financial statements. So the rate on June 30th, then, it goes from $1.35 down to $1.30, and then the forward contract or the future contract goes from $1.30 to $1.28. So then, so again, this is in May. Then June 30th, we're going to say, okay, if it goes down to the $1.30, we'd have the 500,000 times the $1.30. That would be a $650,000 receivable. So then we look at our receivable and it's at $675,000. So we need to take it down to $650,000. So then we're going to credit that accounts receivable for the $25,000 difference. Again, the difference between the $675,000 and the $650,000. And then we're going to have, again, a loss on a foreign exchange. And I'm not really real picky with the wording that you use here, as long as you're telling me and it's a loss and you know it has to do with this foreign currency translation. But then now we look at our future contract and we say, okay, we entered into the futures contract for the 500,000 yen, or I'm sorry, not yen, euros, at the $1.30. Well, now it's down to $1.28. So then we're going to set that change up also. So then it's going to be the 500,000 times the 2 cents, which is going to be a $10,000 difference. And then that's going to go the other direction though. So we're going to set up a forward contract for that $10,000, and then we're going to have a gain. On the forward rate. Okay, then on July 30th, it actually gets paid. And then that exchange rate is $1.27. Okay, so then on July 30th, we would get the cash. At the current exchange rate, which is $1.27. So 500,000 euros times $1.27 gives us 635,000. So that's cash coming in. Okay, then we have to take our receivable off of the books. So then our receivable at the end of the half or the end of our fiscal year, we readjusted it to the 650,000. So I'm going to leave a little space in here. But our accounts receivable is going to go down to, or we're going to remove it at the 650,000. And then we have this forward contract though to take off of the books. So then we're gonna credit that. And then our difference is going to be then, in this case, it's going to be an additional loss. That seems right. And that doesn't seem, that loss seems too high. So I think that part's incorrect. All right, hold on to that thought.